30th, or with your tax returns, if you have more than $50,000 in asset, 8938, and by June 30th, by default, if you have more than $50,000, you have more than 10,000, so you need to file the F-bar form. If you start from now on and filing, maybe you're good. If not, actually there's not much for you to do. So I don't worry, if I were you, don't worry too much, because to worry about what? Nothing, you cannot fix it anyway. Okay, so this was my scary tactic to start and get everybody alert.
I think it's worked.
Please consult your tax consultant, although again, I'm telling you, just be compliant, there's not much to do around it. Yeah.
Going back to your scenario about a foreign investor into a U.S. LLC,
Yeah.
Is there a threshold of 33% before you need to declare a foreign holding?
No, just for
Or
the
it's
first
just one share?
the first percentage. Once he has a 1%, you need to go on the 1065, let's say. You just need to do a foreign withholding.
Would it be to not deal with that? Could he invest in his own LLC and then have that LLC invest in the real estate LLC?
Yes.
So is that a better way to go?
Yes.
Like a Nevada LLC?
Because actually, an LLC can invest in an LLC. So the LLC that all the assets will distribute a K1 for an LLC, which is a US, basically, entity. And then it will go to a LLC, the K1, to a LLC, which is actually, it's a foreign entity, and then all the complication will start. Again, there is in a certain situation, there is even a loophole around LLC into an LLC. So let's say, actually, I'm an LLC that's doing some IT consulting. I'm a vendor for Microsoft. I'm doing some design work, and I'm making about $700,000 every year. And since it's a kind of a service, I'm a very profitable business. My margins are about 30%, so I'm making about $200,000 every year. So my LLC now has basis. And basis, it's critical with LLC. If you don't have enough basis and the LLC is losing money, you cannot take the loss. And we'll touch a little bit about some pitfalls about what is a passive active and what is the everybody become a real estate professional, which almost 95% or 99% of people are not real estate professionals. But so then, if my LLC now, which making some money and have some basis, invest in a real estate development, which actually went south and lost money. So now I have a K1, which is a passive activity for the LLC, going into my LLC. But I have enough basis. So there are situations where on the personal level, you couldn't take any of these losses because it's a passive activity. If you have enough basis in an LLC, there are some situations, again, specific situation, where actually this loss can reduce your LLC's income, your main activity, your IT consulting. So if you are operating as a self-employed person and you have some actual income, taxable income, think about or strategize your real estate investment through this company and try to invest in a way through some existing self-employed mechanism. Just an idea. Let's talk about a little bit about real estate. Real estate has great lobby. Everybody wants to be there. Either if I'm flipping properties, sometimes it's just properties for cash flow. And as Danny and I spoke just earlier, the buy and sell transactions are pretty easy. Try and buy and sell properties in different countries or in Israel. It will take you sometimes 10 years. You know, if you're a real estate developer, you can sit and wait, basically, until you will get all these permits and stuff. But Here is very easy. A real estate agent, a mortgage broker, escrow company, and 5 minutes later, you're owner of a property. Yeah. Where should I put it? Under an LLC. I must say, and don't get me wrong, LLCs are overappreciate or overestimate, or it's great for us, it's creates us tons of work, and we can charge more. The end results in 99% of cases, owning an LLC or investing on Schedule E is the same. The same, which means you cannot deduct the losses, period. So if your accountant or a tax advisor is just taking the losses and your income is above $150,000, you need to ask yourself or him why. It's an easy check the box. Most of our software, you just need to check the box, even by mistake with the mouse, check the box, and now I can deduct up to $25,000 real estate losses, which considered as a passive activity, against my ordinary income from Microsoft. Usually, it's not the case. Usually, if the IRS will try and challenge you, you will not pass an audit. Why? Passive activity, consider something that you cannot wash against ordinary income. Passive losses can go against passive income. That's it. There are many ways how to construct and sometimes to strategize some ordinary income into passive. Again, there's some aggressive way to do. Again, you can do in your tax return whatever you want. And everybody likes to talk about statistics. Yeah, statistics is really low. The chances that the IRS will caught you is extremely low. Extremely low. But be aware that this is what they are searching, because they are aware of these facts. And before, the system was not smart enough to calculate some functions or some diff score, or as they like to call it, on LLCs and partnerships. Today, there are systems, and they're computerized the way that they can catch it. There are ways to do it. And you can see that there is increase in numbers of audits for a real estate or passive activity LLCs. Second, if you want to deduct these losses, you have to be a real estate professional. What is a real estate professional? Real estate professional is someone that participates 750 hours in this specific asset. If I have 5 assets, I need to participate, based on the rules, 750 hours in each asset. Unless you group it.
In each office?
In each. Unless you group. You can group. You can check the box again with the mouse, small check the box, and group it all. There are some consequences to group it. Now I sold one of the assets in a loss. I cannot realize the loss. The loss is going into the group. I need to dispose each and every asset, all the 5 of them, if I need to realize some loss. So there is some consequences to grouping. But let's say we are not grouping. Let's say I have 2, 3 assets that I'm holding on my Schedule E or an LLC. We already determined that it's almost the same. Without taking the legal side, that Avi can talk a little bit more about some asset protection. And I totally agree that it's enough to do an LLC, but not from the tax side. And then real estate professional, 750 hours, one condition. Second, that is supposed to be more than 50% of your income that you generate. So if I'm making...
Sorry, and or?
And.
So both conditions needs to...
Both. So then you say, okay, my wife, she's not working, she's the real estate professional, it's more than half of her income. IRS is accepting this argument. You can argue it, they will accept it. You can argue strong. They will accept it. Either ways. Depends how aggressive is your LLC on other ways.
Well, they're talking about the hours, because if you have a W-2 job, you need to be...
Yeah, but my wife, she's not working.
Yeah, but husband and wife has to be certified individual.
Yeah, but in a community... Washington State, community property state, I think California is a community property state as well. Yeah, if one of the spouses qualified for real estate professional, both qualified for real estate professional.
No, you need to be certified.
What do you mean by certified? If you're a real estate agent, it's not real estate professional. It's not qualified actually.
No, I'm not talking about real estate agent. I'm talking about if you're a husband and wife, you need to be certified as real estate professional individually. You cannot say your wife is not working.
Okay. Let's keep this an open discussion. Philip. So now, I didn't perform 750 hours in my property because I have a real estate, I have a management property, and it's not half of my income, but these three properties, it's a high value properties, more than, let's say, $275,000 each, which can be depreciated over 27 and a half years. So just the depreciation is about $10,000 every year. Three properties about 30,000. I have mortgage, I have property taxes, the rent is not covering it. I have a net operating, sorry, I have a net operating loss. I have a passive loss. This passive loss, let's say it's a Schedule E or K1 from an LLC, passed through into my individual tax return 1040 on line 17, 0. Automatically form 8582 will show up, passive activity limitation carry over, and you don't lose these rights. These losses are going nowhere. They're just hidden in your tax return as a kind of golden egg. Because when you're going to sell these properties, basically you will trigger all these unallowed passive losses. Usually it will go against the depreciation, and you won't pay taxes on depreciation, or even more if the losses were greater than that. But in most cases, high net value individuals that invest in real estate need to understand that the tax savings are not immediate. They are there, but not for the tax purposes you invest in real estate. You invest in real estate for other reasons. Now, let's touch a little bit about the depreciation. And the depreciation, basically it's a must. It's not a choice. If you do your Schedule E on TurboTax, make sure that you consider the depreciation. It's easy enough to understand the concept. If you are using a tax professional, most of the time, I want to believe you will take the depreciation. You need to differentiate between commercial and residential. You need to differentiate between land and building. You cannot depreciate land. So if I bought a condo, what is the value of the land? Okay, so you need to go to the county or to the tax statement that you get, and on this statement, most of the time, you will get the percentage or the portion of how much the land of the total building belongs to you. And you cannot depreciate this value. Once you will depreciate it all, and the IRS will come, it's easy to find. There's only one line on depreciation schedule. But on the real estate, it's supposed to be at least two lines. One for the building, one for the land. I'm missing a line. You're asking the IRS to come after you for things that are super easy to check. I have a Schedule E, I have a rental activity, I have only one line in depreciation. It can be. There are some situations. But in most situations, it's not. This is a trigger.
I just want to make sure I understand correctly. I must use the depreciation?
Must.
I cannot select not to use it?
No, you can select not to use bonus depreciation. So 2011, because of all the recession and everything, so the government is coming with some incentive, also incentive to real estate. And one of the incentives for real estate that you can take on some leasehold improvements, you can take, instead of divide by 39 and a half years, you can take 50% of the expense in 2011. So this is a bonus depreciation. This is huge.
Oh, really?
This is an election. This you can choose just the regular depreciation.
Like a
But there's-
franchise agreement, you can depreciate.
I'm sorry?
If you purchase the franchise, you can depreciate part of it, as opposed to, but it's not real estate, but I'm just thinking.
Franchise, it's again on franchise, it's intellectual property, so you can amortize it over the. Usually on intellectual, it's over 15 years.
Yeah.
I need to check if franchise is I think the depreciation bonus is only on real property.
Sounds like it.
Yeah.
A new
It's
roof,
not on-
maybe, or
Sorry?
a new roof would be.
Yeah. Which actually bring us to a subject. Yeah.
Tenant improvements.
Tenant improvements.
Tenant improvements.
Yeah.
Can be depreciated, like
Sure.
you rent the space, you built out The facilities? Okay.
For sure.
You, repeat the question, or you already
So if
coming?
there's the tenant improvements, if the tenant actually put some improvements into the building, again, you're going into the question of who actually paid the expenses. Let's say that the landlord actually reimbursed the tenant to make it like easy equation. Yes, it's part of his building now, and he can depreciate. And now you're talking about a subject that is, again, it's over the years kind of neglected. And this is cost segregation. Anybody familiar with cost segregation?
I am.
Any of the investors?
Doing it?
Do it? So cost segregation, what it means? It means that you can separate some of your leasehold improvements from the building and accelerate the depreciation instead of over 39 and a half years, over 5 or 7 years. Do the math. I have a building worth $2 million. Inside the building I have air conditioning system. I have roofing. I have carpet. I had lighting. I did some smart electricity system. All the things that actually, in a metaphor, I can take out of the building. And I can separate it from the cost of the building and actually depreciate it on a different method, on an accelerate method. And it's even better. There is a form, 3115, changing in accounting method, which the IRS present for people to decide that they don't want to take a path that they actually choose in the past to take. So they want to do some change. They want to go from cash to an accrual. They want to change the depreciation system. They want to, there's some couple of main ideas why do you want to change something that already filed. But what it means that you don't need to go backwards and amend your taxes. You can take everything on the cash basis today. So let's say I had a $2 million value of a dental practice that I rent, or I'm the owner, let's say. And with the dental practice, I have about $750,000 worth of equipment and leasehold improvements and some unique stuff. But then, actually I was holding this dental practice for the last 5 years, and I never did the cost segregation. I just depreciate everything on the longer side. Let's say 39 and a half years. So now I can take this $750,000, divided by 5, which is crazy. It's $150,000 every year, and multiply it by the last 5 years that I didn't depreciate it correctly, and put it on my tax return, legally. So now I have $750,000 in 2011 depreciation cost, which is part of my cost. It's limited to, again, generally speaking, limited to nothing if I have enough income to deduct it, and I have a $750,000 worth of deduction this year. And it's getting even better. If I don't have enough income, I just create myself a net operating loss, which I can take backwards or forwards. So if anyone has building that it's more than just a single family home, which is something more commercial, something more expensive, which have some leasehold improvement, maybe it's a good idea to get an assessment of an engineer. Basically, the IRS has several methods they have a very specific method, how to evaluate basically what is the cost segregation. But it's easy to find. Usually it's just to hire an engineer. There are some metrics, how we can evaluate it. It's supposed to be backed by a professional, so you cannot just say, I have about, what was the cost? It's not working like that. It's supposed to be backed by an engineer report, usually. Keep it in your tax return for the same year, and just take the full depreciation. Yes?
Only for commercial?
It's usually, it's not only for commercial. It's usually working best for commercial, but it can be a family house, or single family house that you have, and you have, it's supposed to be something significant. It's supposed to be, it's not $2,000 worth of carpeting. It can be $25,000 worth of roof. Yes. It can accelerate the depreciation. Air conditioning system. Something lightning. Lightning. Some expensive decoration of lightning.
What happens when I sell the asset or after 5 years?
So it's a good question because what happens if I sell the asset before? So you need to recap the depreciation, of course. Assuming that, and again, this strategy is really good for people that don't intend to keep this asset for 27.5 years, or intend to have something, take the advantage as much as we can, and maybe to do an exchange, maybe to do a 10-to-1 exchange. It's a separate recap. It's not a regular recap of depreciation. And how do you recap the depreciation, basically? So let's say I hold an asset, single family home, let's say bought it 5 years ago for $275,000. Single family home you can depreciate over 27.5 years, so every year I got the $10,000 worth of depreciation. I hold it for 5 years. I just got an incentive of $50,000 worth of depreciation. When I'm going to sell this asset, assuming in a gain, because recapture of depreciation is to the extent of gain. You cannot pay more depreciation than the gain. So let's say I have $50,000 worth of depreciation, and I sold this apartment. I would do 2 scenarios. One, only for $300,000. So I have only $25,000 worth of gain. I can recap the depreciation up to $25,000. I save basically tax on $25,000. But again, I lost money because these assets won't appreciate as much as I want. But if I sell it in a higher gain, take in consideration that recap the depreciation, it's an ordinary income. Maybe you want to sell it based on price. Maybe you want to sell it based on timing of income. If I know that, I don't know, my wife, she's pregnant, and she will be on maternity leave most of next year, maybe I want to dispose this asset next year. So sometimes we are planning based on death. Sometimes we are planning based on newborn. Actually, this year, for the first time, we actually asked a couple to get married. So they wanted
For the purpose of taxes reasons?
Yes. Yes.
It's a tax wedding?
Yes.
Taxed?
It's a tax wedding. They plan to get married on March next year. He was an high-tech investor that got funded. Everything went superb until everything became wrong. And then he lost about $2.5 million personally as a net operating loss. Her family just sold a commercial space not far away from Seattle in a gain, $6 million. She's a sibling of, they're a sibling of 3. She has a K1 of depreciation and capital gain of about $2 million. Her $2 million with his negative $2.5 million, 0. So probably it's once in a lifetime. or not, or lifetime present, but it's a wedding present for sure. And it's her second marriage and his second marriage. So hopefully it will be kind of success story based on their beginning.
He doesn't have the stock, he's going to get divorced.
He's not paying taxes for the last 2 years.
That's cool.
Yes.
How about if you have a highly depreciated or highly appreciated, say, vacation rental, and you want to take advantage, move into it, and take the homeowner exclusion? How does that? What's the best way to think about that strategy-wise? Or don't do it, just swap it.
Oh, you can do it, but you need to do it again. So if it was a rental and there is some depreciation, you cannot eliminate the depreciation that's already in the books. The only thing that you may be excluded is from the capital gains. So depreciation is done. It will be triggered when you're going to sell it, no matter what. Again, if you report it correctly, which means it was a rental, then I moved there, so now it's kind of Schedule A item. It's my own home, so if I have a mortgage and stuff, everything going to Schedule A, but your depreciation schedule is supposed to be there on 0, which means I'm not taking any depreciation incentive this year, but it's there. You have this Form 8582 that will trigger once you're going to sell it. So things are not vanished from your tax returns. They are being tracked by someone else, don't worry. So if you don't track it, someone else will remind you when you're going to sell it. And the problem with rental, again, depends. Usually if it's a rent or if it's a business property, it's going through an escrow company that will issue you usually a 1099-S. This is a requirement because they will check the history of the property. They will kind of question you. You should be honest. You need to be aware, again, this is the mortgage side, which I'm not familiar so much, but if you took a loan on a single family home as a residential and convert it into a rental, not an issue? Or if you become
No change on the loan will stay with the property.
yeah, and there is no problem that the bank may recall the loan if you did it on purpose. You know it's going to
depends.
be an investment
It mostly.
to reduce your interest rate.
It also depends when you did it. One, and second, what your intentions were when you purchased. So, in other words, if you did it soon after the purchase, it may trigger something. And if you did it something and your intentions were one,
Yeah.
and and then it end up being something else, you may get off the hook. It really depends.
And
It's
then,
not
you know,
that clear.
It's more triggered the other way when you go into a house claiming you're gonna
Right.
live in it to get the sweetheart interest rate and then flip it immediately into a rental classification.
Yeah.
Right.
That's liable to trigger.
Yeah.
But if you're carrying a rental property, you're paying a higher interest rate if you now convert it to single family.
Yeah.
to
Primary
No, I spoke about the first scenario.
Yeah.
Going,
Yeah.
take the sweetheart rate and convert it immediately into a rental.
Could bite you.
So the same with the rental vacation unit. And I'll tell you a story. Why it's supposed to be innocent. So a family in California actually had a house, wanted to sell it. Market was not so good. Actually, they didn't get the offer that they wanted. They decided they're going to stay. They renovated. They purchased it for about $250,000. The market was about, value of the house about $800,000. So even with the exclusion, they're a little bit off. $500,000 exclusion, 250, 500, it's about 750. House worth about 800,000. There is a small capital gain of $50,000. Not a big deal. And then they went to renovate the house. They brought some constructors with an engineer. They found out that in order to renovate the house, foundation is so old, they need actually to tear the house and build a new one. Oh, okay, not a big deal. Actually, make it cheaper. Tear the house down, build a new one, a mansion, something fascinating. 2 days later, they got an offer, $1 million, sell us the house. He said, not a big deal. $250,000, $500,000 exclusion, sell it in $1 million. It's okay, I have about $250,000 worth of capital gains, 15%, not a big deal. $40,000 worth of taxes for almost a $750,000 gain. Cool.